You might think you're a finance major, you might think you're an actuarial science major or management science major, but you're not any of that. You're all risk managers. That's what the job of every business major is. We're all risk managers. That's our most important job. Actually, how many actuarial science majors do we have in here? A few years. Yeah, yeah. So you're risk managers. That's your entire job. Management science. It's all about risk. How good of a job we do at managing risk. If we were really good at it, we wouldn't have a 2008, right? It wouldn't happen at all. So how good are we? We'll talk about it. How good is the airlines at risk management? Or is flying getting safer or getting riskier?
Seems like recently it's been getting risky.
Well, yeah, thanks to Boeing, but over the long term, would you get on a plane in 1940 and fly across the country? Would you trust that? So we'll talk about, Taleb's going to talk about that. Why does the airline get safer with time and finance gets riskier with time? Why is the world riskier? And Taleb believes, we'll talk about quite a bit about his views. He's pretty radical. He says the world's going to be stable, 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 incredibly stable with this big blow up, followed by stable, 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 followed by a huger blow up, stable, stable, and a more huger blow up. Very different than the airlines. Airlines, it's a little different. We'll talk about why that is. But risk management is the most important thing we do in finance. The most important thing actuaries do. It's the more important thing that marketing majors do, management science majors do. Probably, I hope the medical community, hope doctors, risk management is the most important thing they do. So risk management, my name's Ron Sweet. I've been at UTSA for, I don't know, they gave me my 25th anniversary 2 years ago, but I thought I'd been here 30 years. So I can't, they may not have counted the first couple of years. I don't know. When I started, I was working at USA full time and teaching 6 classes here. I don't know how I did it, but so I retired from USA in 2009. I was head of equities. So think about it, 2009, head of equities. Anything happen? 2008, 2009. The stock market was down 50% at one point in 2008. Had my best year ever in 2008. My stock portfolio had a positive return in 2008. We'll talk about that. How do you have a positive return when market's down 36%? We'll talk about the risk management. I do really well in blowups. I'm kind of a Taleb investor. And in finance, you have a great year. What do? You retire. They think you're a genius, you know it's pure luck, but you retire and you leave like, wow, that guy knew what he's doing. I was like, yeah, right. But so yeah, 2008, I actually announced my retirement at the beginning of 2008, not realizing we've been going through this incredible mess. So y'all weren't alive in 2008, probably. Let's see, 18. Yeah, y'all were alive in 08. Were you thinking about it? You were out in preschool. You're out in the preschool saying, hey, y'all see the stock market today? Y'all probably weren't doing that. So I was thinking about it. We were all thinking about it. In fact, I went to my doctor he was doing all of USAA, and he says, what's going on with the employees in the USAA investment company? You guys, your blood pressure is higher. You guys are just sick. And I was like, yeah, come do our job for a while. It was tough. I didn't get much sleep that year. So I went through the 2008 crisis, still probably the biggest crisis, but will it be the biggest? Do y'all think y'all will see something bigger than 2008 in your careers? And if you do, what should you do today knowing that that's going to come? We'll talk some about that. Um, this is called Intro to Risk Management. Um, Traditionally, risk management in most schools is an insurance class, but I teach the 2 insurance classes and we're not going to do it. So the traditional risk management class, it's all about life insurance, homeowners insurance, auto insurance. They spend a lot of time reading contracts, really boring stuff. We're not going to do this. This is going to be finance risk management. How do you do risk management as a finance major? So we're going to take a little bit different approach. Um, if you look at the description of the class, it's identification, analysis, measurement, and mitigation. You're going to see we're going to be using this define, measure, mitigate over and over and over again. Define, measure, mitigate. Your first paper is going to be define, measure, mitigate. That's our process. How does finance define risk? How does it measure it? And what does it do to mitigate it. You'll discover in this class, we're going to cover some stuff you had in other classes, like efficient frontier, like swaps, like standard deviation, correlation, those type of things. And our first big controversy, I'm going to argue that academia has it wrong. I mean, the academia has it right. Sorry, academia has it right, and the business world has it wrong. So we'll start with that. That's a big essay in your first exam. We're going to get into that. It's one of my favorite topics. Then we'll get into the second half, and I'm going to say academia has it wrong, and practitioners have it wrong as well. Both sides, I think, are way off. There's sometimes I think practitioners have it right, academia is off. Sometimes academia is right. So I'm kind of just, you'll see my biases. You don't have to agree with me, but you'll see my biases and you'll see my arguments, especially on when it comes to balance sheet immunization. When we get into that topic, I think the academic is exactly right, and that the practitioner side is just hoping for the best and hoping it all works out and really rolling the dice on some big risks. So you'll see we'll get some controversies in here. It may hurt you in interviews if you bring it up. You got to be careful. We'll talk about my experience with how I viewed, I mean, it helped me a lot in 2008, but how I view managing certain types of risk. And I remember I was at a conference for a guy from AT&T in my same job. We were talking about it, and he said what I believe was really stupid. And he's like 6'7", so I didn't take him on, but I disagree with him. I'm sure we did a lot better than he did in 2008, so I would love to talk to him now and go through that, but it gets pretty controversial. And you'll see, you may not agree with me, but I'm going to bring through the wonderful thing I like about these topics, especially in this first big controversy, is that it uses everything you learn in finance, all in one problem. So all that stuff you learn, you get to bring it back together and look at it to answer one problem and ask, do you really, really believe what you've been taught in your classes? You have 2 exams. You're probably going to groan at this, but I'm probably going to do the essays in class, not as open book because of AI. So sorry about that. Can y'all write for 45 minutes, or is that impossible for you now? When's the last time you wrote for 45 minutes? Can y'all do it? Now, I don't think there's a class after this one, in which case you have all the time you need. So we don't have to rush you out of here because it is tough. I took the CFA exam part 1. It was, or part 2 and 3 were 6 hours of writing. I don't think I could do that now. Could y'all write for 6 hours? They're now multiple choice exams, but parts 2 and 3 are 6 hours of writing. I would put a thing on my thumb and write, and still my thumb was callous for 3 or 4 months. So I realized writing stuff. I wish I could give y'all computers and have you type your answers. That'd be a lot better. But because of AI and students that just want to take an exam answer from a previous class, it's getting really tough. What percentage of papers do you think professors are reading that weren't written by the person who turned it in? You think it's over 50%? It's getting up there, right? It's getting kind of crazy. So 2 exams, there'll be math problems, and there will be an essay. The second exam has a lot of essays, but you get to choose. So say, here's the 3 things we talked about, pick one of these. Here's the 2 things we talked about, pick one of these, that kind of thing. So you get a choice, but we'll do them in class. I might allow you to bring in an index card with an outline, if that would help, just so you don't have to remember everything, but we'll see when we get closer. So that's half your grade. You have this first paper, which you want to start on probably tonight. Start getting onto it. It's the hardest thing in the class, but I give you a lot of time to do it. But students that wait until the very end, it's just impossible. This is a paper that's easy. You start now and spread it out. If you wait to the very, very end, you're just going to be crushed. Who took my health class last, my life insurance class? You remember that second paper? Any of y'all start that the night before? Been impossible, right? That's kind of what this paper is. Not quite that bad, so don't drop the course. This paper is not quite that extensive. So you have a risk assessment, and then you have a risk management project. I love this risk management project. It is very straightforward, a lot easier than the first paper, but you get to do asset allocation, efficient frontier, style analysis, and attribution all in one paper. Really, really valuable stuff to do. And I get you all the data. You don't have to do the data. I pull the data from Bloomberg. And so you have the data. You just got to pick what you want to assess, and it's all there. A lot of students use both of these papers in their interviews. I don't know how your LinkedIn is going. How's your portfolio on LinkedIn going? Did y'all put your health paper out on LinkedIn? You should. Yeah, that's some good paper. Yeah, I mean, that's a good paper to put out on LinkedIn. So how many of your papers and projects do you have on LinkedIn now? You have more than 5? Anybody over 5? Anybody at 0? Should I ask that question? So you need to be getting papers and projects. I had one of our former students. She showed them her risk assessment paper in an interview, and the first question was this a team project? She said, no, I wrote this. They took her right to the next interview because there was a shock. It's a huge advantage. We're talking earlier today, most professors are doing group projects. And why are they doing group projects? Because they hate grading papers, which means most of your competition, they don't have papers that they can put on LinkedIn because their professors aren't giving them. So you have to do the work, but if you do a good job, you have something you can put out there on LinkedIn. And she really impressed them. I've had several students use papers from my class and really helps them in interviews. The risk project's a really perfect one to put out there on LinkedIn. It's it just shows that you understand what firms like BlackRock and Vanguard and Fidelity are doing. I realized in this project, there's software that does it, whether it's Lipper or Morningstar, it does the work for you, but I think you have a huge advantage. And if you do what that software is doing, but you do it by hand in Excel, your comprehension, understanding of that software is going to be much, much stronger. Right, versus someone where it's just this black box and stuff's going on and they don't really know what's coming out on the other side. So there's a powerful there. I do have attendance. I realize people don't like that, but I'm not going to talk to a computer. Networking is extremely important. Your most important network is your fellow students in this classroom. You need to be coming in early, talking to them. I've had 2 students. It's funny. I contact alums. I contact like 4 alums a week. Ask how they're doing. And several weeks ago, I contacted Ricardo, and he emails me back, Professor, how did you know? I said, how do I know what? How did you know we're kicking off our hedge fund on Monday? I had no idea. And he said, we. What I said, well, what do you mean we? So me and Ricardo, we're starting the hedge fund. 2 students I've met in these classes, and now they're kicking off. They're trying to get me to invest with them. I'll see. I got to read their perspectives, but really sharp students. But they met in this class, they met in the investment society, and now they're starting a business together. So come to class. The ones I'm really worried about, the people who just don't come at all. So you can miss 3 classes and send me your notes from the YouTube video, and that gives you full credit. After that, if you miss 4 or 5 or 6, it doesn't have that much of impact. The university essentially says if a student misses, attendance is less than 70%, they shouldn't get credit for the class. I'm like that draconian. I know a lot of professors aren't even having in class anymore. They're just doing everything. I don't know why we have all these buildings with everybody doing anything remote. And I realize your job may be remote. When I talked to our alums, most of them have 1 or 2 days a week where they're remote. It's horrible for your career. My career would have been terrible if we were working remote. The best thing for my career was walking around, especially actuaries, you actuaries in here, walking around and just starting up a conversation with an actuary. That's an insurance business, right? Actuaries, if they don't do their job, the insurance company goes insolvent. They're the smartest people in the building. So take advantage of being here in class, interact with your peers. If you have something major come up, you do get the 3. After that, if you have something really serious, so athletes and military, I will give you a little bit more if you have those activities, but I still want your notes to show that you're watching the YouTube afterwards. All right. So it can add to, if you have perfect attendance, you get an extra 2% on your grade. That's kind of nice. That even if you make them up, that's kind of nice. Once you start hitting attendance of 80% or so, then it starts deducting a point or 2 or 3, and it can. I really don't want to give you credit for the class if you miss more than 50%. There is a high correlation between attendance and class performance. There are a few false negatives. There are some students, I've had 1 or 2 or 3 that have bad attendance but do really well on exams and papers, but they're very much the exception. So I don't want to talk to an empty room. And I know what y'all do. I see it. I sit in the FSC while students are on Zoom for another class. And guess what do you think their attendance, I mean, their attention is? I mean, it's pathetic. Have y'all noticed? See some students are all talking to each other. And, oh, wait a second. Let me put a question in chat so the professor thinks I'm paying attention. And that's what they're doing. There's no learning going on whatsoever. So I don't want to be part of that. So sorry, if you don't like that, just drop and find a professor that is not quite so hard-nosed. If you do an instructor survey, you get 10 points. Go on, fill it out, talk about how you hate that I do attendance or whatever, and then you get 10 points or 1% for that. Some students complain, I don't have enough items. I only have 4. They wish we had more quizzes and those kind of things. This is finance. Accounting is when you have 50 things to do. I was an accounting major, I have my CPA, so it was an accounting. Yeah, the accounting job, yeah, you're doing the same thing every month, like 30 different things. Monday you do this, very structured. I thought my accounting job was so easy. It was I knew exactly what I was doing every single day, very straightforward. And then I jumped into finance. I asked my boss, like, what am I supposed to be doing? He said, well, read your job description. My job description said, make USAA better. I said, okay, that's kind of open-ended. And it was massive projects. I might spend 6 months on one project. So that's the way finance is. It's huge projects that are a huge part of your performance appraisal at the end. So I just prefer that. And I'm hitting some really, really, I think, critical topics in finance on the exam essays. And then the math, I think, is really valuable because it's pretty useful. On exam 1, we're going to do a math problem that if Silicon Valley Bank had been doing it, they wouldn't have gone insolvent. They messed up on the most basic thing. So we'll see where they messed up. Any questions on the grades? There's no ambiguity on the exams. That's kind of a nice thing. You know exactly what's going to be on the exam. We'll work the exact same type of problems. You'll know exactly what the essay problem is, so there won't be any ambiguity. Doesn't mean they're easy, but it does mean you're not going to have to be wondering what's going to be on the exam. You don't have to go out and read 20 chapters of book and wonder what the professor is going to ask. And what is the textbook for this class? There isn't one. I can't find a good textbook for this class, and I don't like textbooks anyway. They're too expensive. My office hours, Tuesdays and Thursdays are the best because Monday and Wednesday we have the investment side does its dashboard team. You're certainly welcome to that. Jacob's been going. I think anyone else in here did dashboard? Sure, but I think it's pretty valuable. We really want freshmen and sophomores in there to help them with their interviews. So I mean, like what happened today? The market was down. We saw 2 things today that drove markets. So Trump and Japan, right? So 2 things, Trump and Japan. Tomorrow it will be Trump and something else, right? So it's just whatever he says about tariffs or whatever. And in Japan's bond market blew up. Where actually Japan has actual interest rates now. Well, if you're going into an interview, you better, go into an interview today, you better be able to say, why did markets do what they do? That's what our dashboard team does on Monday. And on Wednesday, we're going to do stock valuations and looking for stocks to buy and sell. So those happen on Monday and Wednesdays, but I will be there and I can somewhat help you out. But Tuesdays and Thursdays from 2 to about 5:30, I can definitely make myself available. I'm also always available by phone, especially in the mornings. So if you really just want to talk, just call me and I can talk to you. I'm on a bike every morning, right, Jacob? It's even in Costa Rica at 3 a.m. I'm on a bike riding around. So you can call me. It doesn't have to be risk management. I've done some 2-hour phone calls on my bike on career counseling. Students asking, I got this job offer. What should I do? How do I handle it? So you're welcome to call me on any of that kind of stuff. Even your actuaries, I have some background on the actuarial side. I might be able to help you on that. But if you're trying to figure out, do I do the corporate side, the investment banking side, the asset management side, the financial planning side, talk to me. I certainly have strong opinions on those things. So this is just when I'm actually here. I'm in the FSC, which is 1.0104 down the stairs. So I'll be there, but otherwise just call me in the mornings. Don't call me like at 11 p.m. or something, but you can call me. There's my phone number. If you want to email me, my personal email is probably the best, because I'll just get so many emails, my UTSA one, but I'll look at them both and get back to you. Um, Anybody know what this is? What is Mahler 6? What in the world does that mean? Yeah, greatest composer. Yeah, I say you know that. Yeah, greatest composer ever lived. And then the 6 is his 6th symphony. So that's my email account. So it's not the greatest symphony. His greatest symphony is the 9th. So if I had get a new email account, it'd be Mahler 9th at gmail.com or something. But anyways, but you can email me there, email me here, or call me. If you text me, I retext when I'm on my bike, and then I completely forget that I got them. Emails, I got a process where I can keep track of them a little better. So email is better, but if you need something, you want to try to get me, just call me. Talk. I know y'all don't call anymore. Everything's got to be text, but text, I look at them, I just forget that I even looked at them. If you do contact me and I don't get back to you within 24 hours, I probably lost your email, just because I get so many emails all at once sometimes. So just contact me again. Say, Professor, I haven't heard back from you. Here's a description of our project. We'll get into that more. We'll start off the first few classes with some background and history on risk management. And then you're going to see in the notes, we're going to be using the group of 30s list of risk, and we'll just be walking through them. So we're going to start with my favorite of all, which is interest rate risk. We'll spend quite a bit of time there on balance sheet immunization and interest rate swaps. And dollar duration gap, all this stuff that's really powerful that you probably haven't had in other classes. You may have, how many of y'all have had interest rate swaps? Anybody? Y'all have Catapac? I don't know, he covers them a little bit. So we're going to use interest rate swaps to do what Silicon Valley Bank should have done, and that's manage its interest rate risk. What they did, it's really shocking. I'll talk to my friends in finance. Y'all remember Silicon Valley, right? Is that too long ago? So my friends in finance, I have a good friend who's a bank analyst, and he's like, it's just shocking how elementary that mistake was. No bank should have made that mistake. And so we're going to be looking at that exactly. We'll get into liquidity risk, which is the hardest to talk about, but we'll see why. Then we'll get into one that's probably you think the most about, which is market risk. Like today, when the stock market falls 2%, how do you manage market risk? This is where I have the biggest problem with finance, and you'll see our risk tools in finance. They work really, really, really well unless you need them, and then they fall apart completely. So they work well unless you have a crisis. When would you want your risk tools to work the best? I would want them to work best in a crisis, right? You have an airbag in your car and you read it and it says, warning may not deploy in case of an accident. Would that be good risk management? You have a fire extinguisher, warning may not work in elevated heat. Might not be so good. That's what finance is. Our risk tools work really well unless you really need them, and then they fall apart. So we'll talk about market risk and where my problem we have with market risk. We might talk about the second project there. We'll see, because it is a market risk project. Credit risk, we'll probably spend a little bit more time, maybe a class and a half on credit risk. If you take John Tui's fixed income class, he gives a lot more in the credit risk, but we'll talk some on how to look at credit risk. I don't understand why credit spreads are so narrow right now. It just doesn't make sense to me. I wouldn't be buying high yield bonds today, but we'll talk about that. We'll look at that and see if you're actually getting paid for that risk. There's a bunch of other risks that we'll get into. I'm going to be talking a lot about USAA because I saw these things: currency risk, tax risk, legal risk. You know, I saw these firsthand, so I'll give you some specific examples of what I went through and how we try to mitigate them. They're kind of tough, but there are a lot of other risks. So we're going to spend a lot of the class on define interest rate risk, measure interest rate risk, mitigate interest rate risk, define price risk or market risk, measure it, mitigate it. So you see the process we're going through there. Once we finish that, then we're going to see what are the major influencers in this risk management world. What are they saying? Some of these people are a little bit old. Some of the readings we're going to see. but I can't think anyone who's come along that's had more impact than they have. So there's about 4 or 5 of them that have had a huge impact. So Kahneman, y'all ever heard of Kahneman? Does that sound familiar? Nobel Prize winner. So he's really, really famous. He's the one who wrote Thinking Fast or Slow. Have y'all heard of that? So good book. You should all read Thinking Fast or Slow. Annie Duke, have y'all heard of her? Her book is wonderful. I highly recommend it. She's a famous poker player who shows what she learned from poker to apply for risk management for the rest of your life, using a lot of Kahneman stuff. But the nice thing about Annie Duke, she takes Kahneman, who's very theoretical. She makes it extremely practical. She's a wonderful speaker. I'd love to have her come speak at UTSA sometime, but we couldn't afford her. A great, great, great book. Taleb, I mentioned Taleb. Need some Taleb. We're going to talk about, have y'all heard of Black Swan? I'm fooled by randomness. So we'll talk about what does he have to say. He had quite a bit of influence. One thing I would highly recommend that you do, not necessarily for the class, but it wouldn't hurt you in the class. But just look Taleb and Kahneman. I can't type. I don't know how to spell Kahneman. See if I can find it. There's Kahneman. But anyway, there's a YouTube out there where Kahneman and is interviewing Taleb. It is so fascinating. It really is. You discover in that interview just how brilliant Kahneman was. He passed away a couple years ago, unfortunately, but just how brilliant he was. There's a movie about them, I think, right? Tversky and Kahneman. Have y'all seen that? But anyway, let's see if I spell his name correctly, maybe it will come up. A-A-H. Does that look correct? Kahneman. There it is. So here, no, that's not the one, but you'll find it. That may be out there. Yeah, so that's it. So this is a phenomenal. We're going to talk about Taleb and his idea of sorting black swans, and we'll see what Kahneman has some interesting questions to ask him. So this can be really, really helpful when we get into the second half of the class and start talking about price risk. So I highly recommend. These are two of the, well, Kahneman especially is just one of the giants in our field. He's not a finance person. He's not an economics person. He's a psychologist. But he takes those theories of finance and economics and he tests them. He and Tversky tested it. Say, do people actually behave the way the theory says? And he discovered a lot of times that people are not as rational as the theories say, and we do some things that are completely unexpected. Really interesting stuff. So we'll do Kahneman, and then one of my favorites is Doug Hubbard. We will be talking about him. I actually have him, oh man, I cannot spell. Have you watched one of his videos? This is Doug Hubbard. He wrote a book you have to read. He has 2 books, Why Risk Management Failed and How to Measure Anything. Great, great, great books. He's still around. He's still doing presentations. I try to get him to come to UTSA, but he's way too expensive. We couldn't get it to work out. But really brilliant, brilliant guy. I called his firm to see if I could get him to come to UTSA, and the receptionist, she says, "Oh, I don't know if he can do that. He's in his office. Do you want to talk to him?" I was like, yeah. And so he gets on the phone, says, "Oh, sorry, I'm running to a meeting. I don't have much time." And then he keeps talking and talking and talking for like 45 minutes, 30 minutes, 40. He just kept, I said, "You have a meeting." But he loves talking to us. So you should see him on Amazon on his books. When someone comments on his book, he comes in with 6 paragraphs in response to the comments on his book. And he's and this is someone I would love to get stuck next to on a 10-hour plane ride. The poor guy would be sick of me at the end of it, but brilliant, brilliant. So he has a lot to say. You can just tell from the title of the book, How to Measure Anything. He believes we can do risk management much, much better than we are. And you'll see that when we watch the video. He has a lot to say. So we'll spend the last part of the semester really getting into these leading thinkers, and then we'll do some case studies. Here I've got some older ones I still like a lot. And they're really ancient before you were born, but there's so much power in these. I still want to do Orange County. It's so old. I have a guest speaker I might bring in. He spoke last semester and the students, or last year, the students really liked him. He's famous at USAA for uncovering Orange County before it blew up. And he has some interesting comments about a bond manager who uses astrology to pick bonds and position portfolios and other things. Really, really interesting. So I might have him come in and speak. I have some case studies I've been using, and I'd like to bring in one brand new one every once in a while. A few years ago, when we had that big freeze in Texas and we lost all the electricity, I had a guy that knew ERCOT really well and talked about the risk management disasters that they had. After COVID, I had someone from United Airlines come in and talk about managing risk when your revenues drop 90% in 1 year. How do you manage that? And that was really, really interesting. I had a former student who was in charge of risk management for the city of New York. He spoke the last class about well, it was interesting because he sent me his paper, and one of the categories he had was earthquake risk. I'm thinking New York doesn't have earthquakes. That's stupid. And then a couple years later, New York had a big earthquake. I was like, oh wow, he got that one pretty good. But interesting stuff. He spoke to the class. So I try to find something. I've wanted to do the airlines, FAA, and how they handle a plane crash, or not even a plane crash, but even a close call. You didn't have a crash, but something could have happened, and what a good job they do of analyzing those kind of things. So so we'll have some case studies there at the end, and then the final exam, and then you have your final projects. Look how late paper 2 is due. It's due after spring break. So I'm giving you a lot of time. That's not because I want you to procrastinate, it's because it's a tough paper. So start early and get working on it. All right, any questions about any of all of that? Kind of see where we're going. So what does that mean about not being prepared for the exam? It's probably not going to be good. If you make a 22 on the first exam, it's going to be tough. So you've got to be prepared, but it's only 4 things. So be prepared, ready to go. It's just like in real life. Finance, we're put on the spot in a tremendous way a few times a year. You better be ready when that comes up. All right. So a little bit of an intro to the class, and then we'll talk about the project some. So my goal is talk about the tools, measurements of risk that you'll see in your jobs. I do want you to be skeptical. My fear is I'm going to push you to cynicism. I don't want you to be cynical. You should be, after 2008, you should be really questioning if we know what we're doing. But I want you to be skeptical. And you should be skeptical on the job, maybe not too much your first week, but you should definitely be asking questions. Why do we do it like that? We've always done it like that. That's one thing you can hear from Doug Hubbard. You can see Doug Hubbard hates heat maps. I hate heat maps. We use heat maps at USAA. I just thought they were ridiculous. So I love Doug Hubbard that he brings that out. But firms like heat maps, you probably have seen them before. It's the probability something's going to happen and the severity if it happens. You have this chart, and firms have thousands of pages of that. And Doug Hubbard says, yeah, the evidence shows that has absolutely no impact on risk management. Firms that put thousands and millions of dollars in heat maps, this doesn't work. And he has the evidence to show it. Well, I'm pretty skeptical and even cynical that a firm's spending millions of dollars on something we're pretty sure doesn't add any value. Would you want to be in a job where they're paying you a lot of money and you know that it's of no value to the firm? Some people say, yeah, that's fine with me, but I'm not. I don't want to make, if they're going to pay me a bunch of money, I want to add more money than they're paying me. If they pay me $1 million, I want to add 20 million, $50 million of value. But Doug Hubbard's going to say, yeah, there's a lot of people doing stuff where the evidence is overwhelming. He actually says it actually harms the firm. They're spending millions of dollars on something that makes the firm worse off. So that's the skepticism. But Doug Hubbard comes back and says, but there is a solution. We can do things better. stop doing what you are doing. You'll see in the quote, maybe I can show you his quote. Yeah, I don't know if I can find that, but essentially what he says is everything we're doing risk management, we're measuring all the wrong things for all the wrong reasons. So you want to be skeptical, you want to be almost cynical because you don't want to be working in a job where they're paying a lot of money to do something that's of no value to the firm. What will AI do to those type of jobs? It's probably going to figure it out pretty fast and say, why are we doing this? Probably faster than humans. And then you want to be critical thinkers. That's the most important thing for a professor to do for you, is just to get you thinking in weird ways that you never have thought about before. Academically Adrift says teaching students to think critically is the principal aim of undergraduate. But this book also says 40% of students who graduate from college are no better educated when they graduated from high school. 40%. That's kind of a waste. And this was before COVID. How is it after COVID? I have students graduating with 4.0 in finance that I would never hire in finance because they know nothing about finance. So they kind of wasted their 4 years in college. So critical thinking is the key. That's why I say skeptical. You should be questioning everything. I don't mind you questioning me. Say, wow, I don't think that really works. Or are you sure that's the best way to do that? That's the way you should be doing that, thinking all the time. James Montier, one of my favorite writers, he's at GMO now. In a world of modern finance, a love of numbers has replaced a desire for critical thinking. This is essentially what Doug Hubbard's going to say. As long as you got a number attached to it, it must be good. We got to do it. What Doug Hubbard argues is we don't measure what we should measure. We measure what we can measure. So you got this massive risk over here, but you don't do anything with it because you don't know how to put numbers to it. And you got this little bitty risk over here, and you got numbers out to 17 decimal places because you got a lot of data. You're managing the small thing, and you're missing the big thing. You'll see one of my quotes, I have some strange quotes. One of my quotes in this class is, you shouldn't be worried about your cholesterol level when someone's got a gun to your head. And you might say, yeah, but I can measure my cholesterol. I can get a blood test. I know exactly what it is. I know its relationship to heart disease. I don't know what the guy with the gun's going to do. I can't measure that. Does that make sense? It's like, yeah, you got a gun to my head, but I need to look at my cholesterol level right now. It doesn't make sense. Doug Hubbard says that's what we do. Why? Because cholesterol is so easy to measure. A maniac with a gun is hard to measure. So if something has a number attached to it, it must be good. We can do it. Whereas there's a lot of stuff in risk where we have a tough time putting numbers. Doug Hubbard's going to argue that there are numbers out there. And then sometimes just 3 numbers can make you far bit more intelligent than nothing at all. So we should at least touch on. A lot of people say we can't manage that because we can't measure it. And Doug Hubbard's going to say no. And that's what James Monty is. We tend to focus on the things we have numbers and ignore the most important things because we have trouble putting numbers on them. One of my favorite writers, so I do highly recommend you read him. He has a couple books out there that are really, really good. Peter Bernstein, he passed away several years ago, but he's the one who wrote Capital Ideas. And we'll talk about his other book, The History of Risk Management. I have to bring my History of Risk Management because I've got his signature in the front of it. It's pretty cool. I went to a conference with that book and I was reading it. I had no idea he was speaking at the conference. And so I go up and have him autograph it afterwards. Brilliant man. But he says there's too much math, not enough thought about what risk really is about. We have to make decisions with unknown outcomes, so we have to think about consequences as well as probabilities. So we'll see this more with Taleb as well. So I do recommend Peter Bernstein's The History of Risk Management. It's a little dated now because he wrote it probably 20, 30 years ago, but it's a very, very good book. His Cap Ideas is phenomenal. It was updated. He did update it, so it's maybe 10 years out of date. But he does finance the way I think maybe we should teach it. He teaches, his book is finance chronologically. I almost think we should do college that way. So first we learn this, because of that we could do these 3 things, and we could do these 9 things, and it just branches out how we learn on top of each other. And finance is really, really, really strongly based in the 1950s and 60s with Markowitz and Sharpe. And then Black Shows in the 70s. There's a really bunched up and just a few brilliant minds. And Peter Bernstein does a good job of walking through the. Are y'all reading books? I don't read them anymore because I can't read up close. So mine are all Audible. So Andy Duke, I listen to Audible. I do a book reading list. I don't know if I put it on the site, but I do my recommended reading list. I'll be reading. It's nothing sounds better in an interview than like, yeah, I was just reading Andy Duke's book, and what she said was that's what they want. The number one thing employers are looking for is curiosity. So if you're bored in your classes, you're not doing anything outside of class, they're not going to like. To go. Whoops. What is that? Am I still on? Did AI just decide to interrupt my class? I didn't need it. So read books. James Montier has a good book out there on behavioral finance and investing. Peter Bernstein has two good books out there. Doug Hubbard has two great books out there. Annie Duke only has one good book out there. She's written two, but only read the first one. The second one is a little redundant. Kahneman has a great book out there. These are books you should they should be required reading for finance majors. It's just that critical, and for actuarial majors as well. What do I expect? Come to class, come every class. I went to UT Austin 6 years, 236 hours of college credit. I missed two classes. I had the flu, and I had a march in President Reagan's inaugural parade. But other than that, I didn't miss any class. And I have students that are just that dedicated. Come to class, make it a networking opportunity. Be prepared. I'd recommend read the class notes, do some internet searches on some key terms. There's sometimes you can't do internet searches because finance, we have one term that means 10 things. And so when you search that term, you may get the other 9 things. Sometimes we have 10 terms that mean one thing. So we make things confusing. But I'll try to help you. Like if you research this, read about this, you could find some really, really good information on that. Don't use the computer in class except for class stuff. Don't be checking. I hate it when I look up and students are on their phones. There's nothing more insulting to a professor or for anybody. You're actually better off if you don't use a computer at all. You take handwritten notes. Studies have shown your comprehension and retention is far, far, far greater if you take notes. When I was in college, I took handwritten notes because we didn't have computers. And then I went home and recopied my notes. And then I was hoping I had a problem with my notes, so I have an excuse to go talk to professor and interact with professor. Hey, I took notes on this. I didn't get this quite right. So that helped a lot. I was really popular at UT because my notes were really, really good. People were always begging to get my notes, but you're better off handwriting because something when the brain is writing versus typing, it just sticks with you better. Trying to leave in the middle of class, I just assume that means you're upset at something I said or you're bored or something. We talked about the flat Earth group last year, and a guy got up right when I mentioned that. I was like, oh man, I must be a flat earther, and I just insulted him or something. I don't know. But some students are really, really good about it, where they'll say, hey, professor, I got to leave at this time, or I have my mom's having surgery, I got to check or whatever. And that I appreciate that. Tell me in advance. Produce exceptional papers and essays. I want to get your paper and run upstairs to Dr. Wald's office and say, you can't believe an undergraduate student wrote this. And I mean in a good way, not in a bad way. You can't believe this paper. It's really, really good. I want you to blow me away with your papers, your exam essays. Be engaged, look engaged. If you want your professor to have energy, then you have energy. Look up, ask questions, be involved, be engaged. Trust me that what we're covering is pretty critical to finance. I remember in this class many years ago, we were doing balance sheet immunization, and the student said, "Oh, this is just academic busy work." And he said it the day before we were meeting with the CEO to do exactly what we were doing in that class. It's like we're making multi-billion-dollar decisions, exactly what we're doing in that class. And he said, "Oh, it's just busy work." Well, trust me, I'm not going to give you anything I didn't use in real life. None of this is textbook. This is real life stuff. Just trust me. If 20 years from now you discover it doesn't, then call me, I'll reimburse your tuition and we can just say, yeah, you wasted your time on that, but nothing in this class. I had one student comment on the review that he was upset because he said this professor only covers the stuff he thinks is important. And that's absolutely true. I do not cover stuff I think is unimportant. I only cover the stuff I think is important. Any expectations you have for a professor? What bothers you the most about your professors? There's some things I probably can't change, but I do talk fast. Sorry. I can't help that. Your professors are all perfect.
Mhm.
So if you turn a paper in on Friday, you'll have it back on Tuesday. So I try to turn papers back in fast. That's actually one of my pet peeves, that professors don't turn papers back fast. So I'm going to keep that up. As most students don't say they like that, but I think it's actually pretty important. I've heard professors that get multiple choice exams that get them back like 2 months later. I just think, wow, that's, what value is that of you? You make a 70 on a multiple choice exam and you get it back 2 months later. What was the learning process in that? So I do want you to have your papers back pretty fast so you can see what I was doing. So I'll try to do that. I don't know if there's something that really bothers you about a professor, let me know and I'll try to avoid it. As far as your papers, there's a coverage. There's stuff that you have to do to make sure that's in there. You'll have a rubric of some sort to have that. But also clarity, how well do you write? Needs to be well organized. I should look at it in 10 or 15 seconds and see exactly how you're organizing it. A good use of titles and subtitles. Keep your paragraphs short. Don't make them. I had one student turn in a 5-page paper and it was all one paragraph. It's just horrible to read. It's really terrible. So break it down. I don't need a bibliography, but don't give me other people's words. So you can say according to and quote them. It's probably good to keep track of where you got something so you can go back and find it. You can certainly clink in the internet site that you use. Bold key terms, no fluff. If it's not adding to your paper, take it out. This isn't, I don't grade based on the number of pages you turn in. It's the clarity. So that's where my first boss's boss in finance was he had a degree in English and a PhD in economics. Man, he could write. I would go in with 6 pages and he would cut it down to a page and a half. And he said more in a page and a half than I said in 6 pages. He was just amazing. He wasn't real nice about it. Sometimes he would just rip my paper up. He's like, why are you saying you don't need all of this? And one of the problems I have with my writing and finances, I want to prove to the person, to my audience, that I did all the work correctly. And my audience didn't care about that. Of course you did the work. That's why we hired you. Just give me the conclusion. I want to say, hey, I did this number here, and I want to show off that I did all this analysis and all great. And it's like, no, they don't need that. So, get to the point. And then critical thinking, these kind of phrases that are so powerful in your paper. I find it interesting that your professors smile every time you do something like that. I was surprised to learn that. I wonder if, that's a really critical thinking question. So you're going to do paper 1, you're going to look at the committee structure. I wonder if the responsibilities of committees don't overlap too much, that it becomes confusing who's responsible for what risk. I was curious to see if they do stress tests and report it in their annual report. We'll talk about that. I was amazed that. That's a pretty good comment. I question if, that's kind of, I wonder if. I think they should also consider, that's really critical thinking. So yeah, they have these committees, but I think they should also consider giving more responsibility to their chief risk officer or something along those lines. I think this is a unique strength of their process because, and you can see especially in paper 1 on that, this is really powerful on the paper. This reminds me, I love this, you want to make your professor happy. I love that student says, this reminds me of what we discussed in class, blah, 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 blah. That's really good. You made that connection between what this said and what you heard in class. That's powerful. Or even better, this contradicts what we discussed in class because Professor Sweet said this, but they're doing this. It's a contradiction. You can say, I think they're right and he's wrong. That's fine. Draw on other things from outside of class. If you want to do a chat GPT and ask AI what it thinks about that. Your own outside reading. Sometimes you got some jargon, and especially paper one, jargon to handle. You might quote them, maybe their definition of liquidity risk, and it's really confusing. You say, what I believe they're trying to say here is, and put it in your own words. That's a critical thinking activity. So kind of that last point. These are the kind of things I'm looking now. Having this in your paper is good, but it's also, if you're going to add them to the paper, it's also good to ask yourself that question. And working on the paper, what did I find interesting? What was I curious about? What was I amazed about? Don't do like some students do, is they finish their paper and then randomly go back and throw these phrases in. That doesn't work. All right. So what was actually amazing? Paper one is jargon heavy. You're going to see it's really, really tough. Those in my security analysis class, either of y'all doing banks? So paper one will really help you in that class because banks are really hard to analyze. You read the annual reports of most companies and it's pretty readable. Banks have about 50, 60 pages on risk management and it's heavy jargon. A lot of terms that they don't define, they just assume you know, and it can be tough. So here's some websites. Glenn Holton, really good writer. One of my favorite articles is his called Defining Risk, a really good article. I love this website. It can help you on paper one. You might actually be able to find your bank in the site. The New York Stern School of Business, they created this website to assess the risk of banks, which is essentially what your paper one is doing. I have in my reading list, the very last book I have in my reading list is called Regulating Wall Street. That sounds like a really boring book, but it's a really good book. These are the guys from New York Stern that created the website. And essentially what they did is look at Dodd-Frank, which was the regulation coming out of 2008, and they assessed to see how good it was. And they said it really wouldn't have, if Dodd-Frank had been in place in 2006, 2007, it would not have prevented the 2008 crisis. And oh, by the way, here's what would have prevented it. And that's why they created that website. They said there's a much better way to do it. It's a really good book. And interestingly, it's about half the length of Dodd-Frank. So a book about Dodd-Frank is shorter than the actual bill itself, but really good book. It sounds so boring, but is really good book. But that's their website, and I haven't been in it in a while, but there are ways you can go there. You can just look at it as it's set up just for curiosity questions, particular risk you're looking for. CMRA, great company. I'm not sure. Their founder is getting up there. I think she's been doing this for like 40 years. Senior professionals. Let's see if she's still there. Yeah, Leslie Rawl is still there. We interviewed them 40 years ago, and that's the exact same picture that was there 40 years ago. So I don't know what she looks, maybe she looks exactly the same, and she's really did. If you start, now Glenn Holton had his same picture up there for like 20 years. He finally changed his picture. Like, wow, okay, so he's gotten up there. But brilliant. We interviewed her, and I was like sitting in a room, like I wasn't going to say a word. It was Leslie Rawl and I forget the other person, but the two of them, like the two smartest people I've ever met in my life. And so my boss was there. I'm not saying a word because if I say anything during them, I'm stupid, and just really impressive. What kind of firm is this? Well, when Lehman Brothers went under in 2008, this is the firm they call. We need someone who can walk into an incredibly complicated firm doing incredibly complicated transactions and figure out what value is there, figure out what is going on. And this is the firm they call. Really impressive firm. We didn't end up hiring them. They were a little bit overqualified for what we were looking for. Now Barbara, it was she and Barbara, and then Barbara, I think, retired, and this guy Peter came in. Really impressive. I'll show you one of the things off their website on risk, universal risk. Really, really good. But great firm. Looks like it's still in business. And then Hubbard, we'll talk about Doug Hubbard and some of the stuff that he's doing is really fascinating stuff. Here's my books. We talked about Peter Bernstein, Nassim Taleb. I actually like Fooled by Randomness better than Black Swan. We'll talk about Anti-Fragile. I didn't like Anti-Fragile, but I like the idea of Anti-Fragile. The book itself, I didn't care much for. Taleb says that's his most important book, but it's just not written as well as the other two. But I love the concept when he talks about anti-fragility. Kahneman, Thinking Fast and Slow. That's actually the one you need. And then the Undoing Project is Michael Lewis writing about Kahneman and Tversky and their life. And I'm not a big Michael Lewis fan, but he did a good job on this book. He really made it interesting. Here's Annie Duke, really good book, highly recommended. Doug Hubbard, The Failure Risk Management, How to Measure Anything. And here's a book that's very similar to a lot of Kahneman. There's a lot of Kahneman and Annie Duke, and in this book, Kahneman is so important to risk management. And so you'll see a lot of people that are essentially taking what he said. I mentioned James Montier earlier. His book essentially is Kahneman, but applied to stock investing. So you'll see how important Kahneman is to everything else in finance. And then this book, really good. So those are the ones, I'm not saying you need to read them to do well in this class. Just read them in your spare time. You don't want to read Kahneman's entire book. You can find out on the internet in his lectures. We'll be looking at a few of his lectures to see what he has to say. One of his favorite concepts is the idea of experience versus memory. Really powerful for finance, and we'll get into that in some. So, but almost everything in his book you can find in his online lectures. All right, boy, all right. Any questions on any of that? You don't like reading? You may need to change majors because we'd read a lot in finance. Just a lot. When I was over investment strategy analysis, I assigned an article to my team every week, and we talked about it in our staff meetings. What does this mean? You're looking for ideas, any place you can get it. So just read. Doesn't have to be books. It can be articles or podcasts. There's some really good podcasts out there that cover this stuff very well as well. But just expose yourself to new ideas as much as possible. All right, so if any of y'all ever seen Deal or No Deal, the TV show?
Yeah.
So great program. So here's one. So there's a bunch of people up there holding boxes, and the contestant gets a box. And one of the boxes has $4 million, not in it, but it says $4 million. You'll get $4 million. And the others have anywhere from $5 up to $4 million. So I don't know how many boxes there are. Maybe there's 30. And the contestant hasn't opened one of the boxes out there. And what is she hoping gets opened up out there? $5 or $4 million? Five, right? Because if it's 5, then that kicks out the 5, and the bank's going to make a bigger offer. Because the bank says, hey, you know what? If you stop now, we'll pay you $701,000. So she's got one chance of 6 of getting $4 million. She's got one chance of 6 of making $5. Or she can take $701,000 now, right? So her choice is take $701,000 or open another box. You don't have to open all 5 of them, open another box. There's a pretty good probability 2 out of 6. Then the next box, when it opens, it's going to increase what the bank offers because it's going to be 5, 300, 10,000, or 25,000. If she opens any one of those 4, the bank's probably going to shoot up 100,000 or more. What happens if she opens the 4 million? What if she calls on the person who has 4 million? What happens in the bank offer? It'll drop a lot, right? What do we call this? And what do we call the 701,000 in finance? What kind of offer is that? It's the blank offer. Is that term we use in every finance class? The 10-year treasury yield. What did y'all call that? The risk-free offer, right? That's her risk-free offer. $701,000. All right. How do you measure all of this? What's the most obvious thing we do in finance? We call that the what value? The expected value. How do you figure out the expected value? You just take the average of these six. Is that really the expected value? The average of those six, I forget what the average is. The average is 839,218. We call that expected value. What's the probability she's going to walk away with 839,218 if she opens all the boxes? It's 0%. Why do we call something that has a 0% probability? Why do we call that the expected value? It's kind of strange, isn't it? We're weird people in finance, aren't we? The median is 17,000. The average is 839. So is that a skewed distribution or not? Pretty skewed, right? To the right side, quite dramatically skewed. So what should she do? How would you recommend? You're a finance major. What would you recommend that she do? Should she open another box or should she take the $701,000?
Depends on what risk she wants.
All right. Well, how would you help her do that? How does she assess her own personal risk tolerance? What questions would you ask her?
How bad do you need the money?
All right. If she's desperate, she owes $2 million. And if she doesn't pay, she's going to jail. Yeah, that might influence it. We'll talk about that kind of risk. Is there any obvious way to help her know what to do?
But if she owes $2 million, she only has one possibility of getting more than $2 million.
Yeah, so if there's some extreme case, you could kind of argue that that can be true of stocks too, right? If you've got to make 25% next year, you're probably your best thing to do is stick all your money in one stock. That's what I talk about in the investment side. They have this market game they play. I say, you should take massive risks because if you win, you win $100. If you lose, no one knows. Your goal in the game is to do what? Make $100, right? Your best real ability to make $100 is to really risk it. So that's a pretty extreme case. But can you find an obvious way to help her? Can you give her a formula to do this? So we have the expected value, which is the average. You have the median. You have the upside risk, the downside risk. You have the bank offer. It's kind of interesting. This is a problem involving money and risk, which sounds to me like finance, doesn't it? And you're now seniors in finance. You should be an expert on helping her make this decision. Do y'all feel qualified to help her make this decision? It's a pretty tough decision, isn't it? This isn't a very normal finance decision. You don't see this every day, but we do have the problems like this. If you did this every single day, day after day, you'd be making that kind of decision over and over again. But it's interesting that something that's so basic finance, and you have all these finance courses behind you, it's not obvious how to help this person. Her husband's like, no, take the 701. I think her dad's like, no, keep going. So she's getting advice. We know people on these programs tend to take more risks than they normally would outside of a TV program. So it's hard to say. One thing, if I were going to spend money, I would spend money on the bank's algorithm. I would want to know, wouldn't you want to know what is the bank going to offer? If I pull the 4 million, what's the bank going to offer? I pull the 5, right? Because the expected value really doesn't matter here because she doesn't have to open 5 cases. She only has to open 1. So that changes the dynamic quite a bit. She only has 1 chance of 6 of opening the 4 million. Now, if she opens the million, that might hurt her a little bit, but probably not that much. But she opens the 4 million, it's going to hurt her. So it's a tough decision. I don't remember what she did. I used to show the video of this, but they took it off of YouTube, so I can't show it anymore. As at the time that this video came out, it was the highest bank offer ever on that program. Is there an optimal solution? And so I guess the point Chris is making, everybody's different risk tolerance, so there may not be an optimal solution. But even if we know her risk tolerance, is there an optimal solution for her? Or she say, that's the obvious answer? My guess is it'd be even tough even to say that.
Yeah, feasible solution.
Huh?
A feasible solution.
Well, feasible, but we're asking, she's got to make a decision to do it or not. And is she going to find a way to make that decision that's going to be better than a coin flip? And it gets a little tough. Some people say, um, it doesn't really matter because she started with zero. You hear that on Sunday's program. I got here with zero, so hey, might as well go. That's absolutely false. She started with zero. Well, where is she right now? How much does she have right now? She has $71,000. The fact that she started at zero, does that matter? Doesn't matter. It's completely unrelated to this problem. Right now, she has 701,000 bucks. I remember this high school teacher, he said, oh, I tell my class, until you sell the stock, you haven't lost anything. No, if you bought it for 100 and it's trading for 20, you lost 80 bucks. It might come back to 100, but the fact that you bought it at 100 has nothing to do. You've got something worth 20 bucks, right? If you have something worth 20 bucks that you bought for 100 bucks, should you hold on to it or sell it? If you think it's worth 10 bucks, what should you do? You can sell it for 20, you think it's worth 10, what should you do? You should sell it. If you think it's worth 30 and it's currently trading for 20, what should you do? Hold. You should hold it. How did the $100 affect your decision? Other than taxes, it has nothing to do with it, right? So tell her that she started with zero is completely unrelated to this problem. She has 701,000 bucks. That's the only thing that matters right now, as far as where her starting point is. So don't use that argument. This is a very skewed distribution. High probability the next bank offer is going to be higher. Pretty tempting to open one more box in that case. I forget what happened to it. If I think I had the numbers. If she opened 5 versus 4 million, it was pretty dramatic. Both of those pretty dramatic. The opening the 4 million was far more dramatic than opening the 5. The 5 took it up like 100 or something, and opening the 4 million took it down several $100,000. So her risk of opening the 4 was much greater than opening the 5. Now, if she opened the 5, 3, 10, or 25, it had almost no impact. The bank was going to go up about the same amount. Huh?
Did you know the formula for the bank's offer?
I try to figure it out. Someone says that it's out there. I know the show makes it look like the banker's up there and he's trying to figure it out, but I'm pretty sure he or she knows the second they open the box. I doubt their insurance company that's covering them is going to let some person in Hollywood say, oh, hey, let's offer 787. The bank offer is always lower than expected value, which makes sense, right? Because you have the risk-free rate. Your risk-free rate should always be lower than the expected return, or you just would never do the transaction. You just buy the risk-free. All right, I think we have enough time just to do this. Let me show you this last one. I don't know if y'all know this movie. It's way before your time. It's great, great, great movie.
When a shopping cart smashed.
Go through the
we worried we'd have
204.
to try to get paid for such a small claim.
And I from the top around the shopping cart.
Oh, that's not it. It kind of looks similar to what I'm going to show you.
To get going and it feels good to get going. Like working with your hands, train at Universal Technical Institute to build real world skills. We wanted 15
Where's the
hands-on
skip?
programs. Start a new path now.
All right. Okay. So this is a Steven Spielberg movie that you probably have never seen. It's a really good movie. It's called The Duel. Anybody have seen this movie before? It's his first big movie. I think it had a budget like 40,000 bucks. You see Steven Spielberg in it. It's a risk management one. This is Dennis Weaver. He's got this little car that he's driving and he passes his truck up a hill and the trucker doesn't like it. For the rest of the movie, this trucker is road raging against him and going after him. You never see the trucker. Steven Spielberg actually makes the grill of the truck the enemy. You never see the truck driver, you see this truck. So what does Dennis Weaver do? He decides to do conventional risk management. You got a road rager, what do? You call the police. All right. Let's see how conventional risk management works. All right. How did conventional risk management work? When you get in this situation, you have one goal now. This is 2008. You've just been destroyed by the 2008 crisis. What is your only sole objective in risk management? Nothing else matters. What is his only objective now?
Survive.
Survival. So risk management, there comes a time in risk management, you throw everything out you've ever learned and it becomes survival. We'll talk some of those situations. That's where Dennis Weaver is. A great movie. Dennis Weaver, the truck driver, he had such a low budget. This is actually Dennis Weaver, and he's actually having the truck come up behind him. There's no, AI. And the trucker was told, if Dennis Weaver's still in the box when you hit this white line, turn off. And so Dennis Weaver risked his life. So we'll talk about risk management. But we will talk, there are times where you just throw out everything you've ever learned and you're gonna have to make it up from scratch. And that's kind of what we had in 2008. All right, so next class, we'll talk some about the paper one so you can start working on it. So I'll see y'all on Thursday. So last class, we did a real quick intro to risk management. Tonight, what we want to do is I'll give you the larger process of risk management, but we know we're heading toward the real simplified approach of define, measure, mitigate. So I'm going to give you a broader sense of that. We'll talk a little bit about risk universes and what that means. And then I want to take some stuff you've already learned in college and just refresh our memories on it and talk about some problems with some of the stuff. If you were like I took statistics a long time ago. All we had was just calculators. Thought, man, I'm glad I got that class behind me. I'll never need that again, and discovered it was the most important class I took. So stats is really, really important, especially for risk management. But there's problems with the way we use it, so we got to be aware of those problems. Are you Dane? Okay, I'll get you on the.
Sorry.
No problem. Get you on the CD chart. So we'll talk through some of those. Some of them you probably heard of in your stats class. Some you may not have heard of before. But they're terms that you hear a lot in risk management. You really want to make sure they're clear in your mind. And I'm going to pull that data from, remember we talked about Peter Bernstein last class. He wrote the book, The History of Risk Management or History of Risk or something, but he covers those in that book pretty well. So if you want to get a good overview, that book is a good one to use. So we're going to take this define, measure, mitigate, and just break it out a little bit more. So this is a typical textbook risk management process. The define has two components to it. The first is just understanding what your organization is. What's the mission statement of your organization? This is going to be important when you do paper one, when you do your bank assessment. You really want to understand what the organization is. USAA, when I worked there, they had a very clear mission statement. They wanted to serve members of the military, especially officers and their families, wherever they lived in the world. That caused some terrible problems because a lot of military officers like to retire on the coast where there's a lot of hurricanes. And because of that, USA Homeowners was just a terrible, terrible product, but that's what their mission statement said. We're going to ensure military officers and their families wherever they want to live. They want to live in dangerous places, we'll offer them homeowners insurance in dangerous places. So that mission statement is pretty important. It's true for you individually as well. What is your goal in life? You're going to start there because risk will be related to what you're trying to accomplish. Start with that mission statement. So when you do paper one, you're going to do an assessment. We'll talk about paper one a little bit more tonight once we get this process. If you're going to do a risk assessment of a bank, you really want to go out and see what is their mission statement. Especially with the bank you choose, is how far down of their risk statement do you have to go before the word risk makes its first appearance? And I looked at some of the big banks like JP Morgan, Bank of America. Some of them risk is very high up in the mission statement. Some of them you just don't see it anywhere listed. Once you know why you exist, then you're going to do a risk assessment. That's also part of the define. Risk assessment has two components. One of them is part of the define, the other one is part of the measurement. But what you're going to do in the first part is identify two things: exposures, perils and exposures. A peril is a risk that's going to hit you. The exposure is what is harmed when you get hit. So the peril, it doesn't have to be something outside, but it usually is. So if you're a bank, the peril might be interest rates, and the risk might be the valuation of your assets and liabilities. So the peril is something that hits you. The exposure is what you lose. An asset, a liability. An asset falls, a liability goes up in value. That's what you're looking at. So perils and exposures. This is where firms tend to use what's called a universal risk. USAA had a universal risk. When I left there, their universe was up in over 90 items. Some of them are a little bizarre to me, the way they did them. Obviously with USAA, I mean, you can guess, what is USAA worried about? What's probably their single biggest risk? Any guesses? You won't see it in January, February, March, but what is their biggest risk? Even bigger than that. Because you don't have the entire country having auto accidents all at once. But what do you have? Texas? Not, there's a bigger one. Disaster. What kind of disaster? What's their biggest disaster? Hurricanes. That's their biggest one. What comes second? They're hurricanes.
Tornadoes.
Well, okay, wind. We'll put all the wind together. Hurricanes, tornadoes, tsunamis. Flood, they don't insure floods, so they don't care about flood. So if you buy flood insurance from USA, what are you buying? Whom are you buying insurance from? The federal government, right? They don't insure flood, but what comes after wind and hurricanes? Earthquakes. That's their next one. So you notice I mentioned homeowners insurance for USAA. If they just told people on the coast, we're not insuring you anymore, they could probably write every one of their customers a $5,000 check. Because they hold so much net worth just to cover the homeowners living on the coast. When I was at USAA, 4% of their customers accounted for 96% of their risk. If you were a USA, what would you do? I would drop the 4% and just shower the 96%, the others with all this money. If you're a USA customer, they say, hey, you know what? If we just eliminated people in Florida and California, we could send you $5,000. What would you want USA to do? I say, send me the 5,000. So that's a peril for USA. They do offer life insurance. Are they really worried about a lot of people dying all at once? They've run some scenarios. It's not a big number to them. Hurricanes are $3, $4, $5 billion. A huge life event like COVID or a plague of some kind, that's like a few $100 million. It's not that huge. So USA has those perils that hit them. When I looked at USA's universal risk, they had some bizarre things on there. One of the things they had on their list was their net worth. They had that listed. When's the last time your net worth attacked you and caused you harm? Anybody? Your net worth, like in the middle of the night, you're sleeping and your net worth runs in and starts strangling you. So what did they do? They put an exposure, not a peril. They put some exposures in your universal risk. That doesn't make any sense. Your universal risk should be things that are going to harm you, not the things that get harmed. Okay. Now, what about an employee? An employee can be both a peril and an exposure. So you have an employee working, it's a wet floor because they spilled something on the floor, so they're the peril. And then they slip and fall and hurt themselves. They're also the exposure. You have to pay workers' comp to them. So some things can be both a peril and an exposure, but net worth cannot be a peril. Your net worth is not going to hit you, but if USA has a hurricane, it's going to lose net worth. That's the exposure. All right. So you identify those things. A lot of times on the personal side, your financial planner will have a questionnaire. Do you have a home? Yes. Okay. Do you have homeowners insurance? Do you have a car? Do you have auto insurance? Do you have health insurance? They'll go through a questionnaire to make sure they're looking at those perils and those exposures to help you. But you have a universal risk. What's the problem of going to your financial planner to help with that? They're only going to do things that do what? Have a revenue attached to them. Right? They want to make money. So that means there may be exposures and problems you have that our industry doesn't provide protection for. You still need to worry about those kind of things. But a universal risk. Here's a universal risk. Remember CMR? I mentioned CMRA, that firm I really, really love, Leslie Rawl and Barbara. I forget Barbara's last name, just an incredible firm. This is their universal risk. It's kind of a bizarre list. There's probably things in here you probably think, what is that? We're going to talk about this one, asset liability mismatch. That's what put Silicon Valley Bank under. We're going to spend quite a bit of time on that. Concentration risk, you have too much in one company, and that company goes insolvent. Let me find one that, contract risk, we're gonna talk about contract risk in here. They say netting, we're gonna talk about netting in paper one. I don't know why netting's on that list, it's kind of a strange one, but netting's really more of a mitigation than, anybody know what iceberg risk is?
Is that like when the risk seems fairly like feasible to attain, but then there's a lot of other things that you don't really see under.
Underwater, yeah, that's kind of why I think they're thinking the Titanic. You look at it, it doesn't look that big, and when you hit it, it wipes you out.
What's haircut risk?
All right, haircut risk, we'll talk a little bit about that. So what haircut risk means is you have this asset, like you buy a high yield bond. You know some of them are going to default. So you buy a bunch of high yield bonds, below investment grade junk bonds, and they're yielding 8%. They're not today, but they should be yielding 8%. We say we're not going to make 8% because some are going to default. Let's assume we only make 7%. That 1% is the haircut, right? So you say, let's take a 1% haircut. Well, what happens in 2008? 1% is not enough, is it? You lose 40, 50%. So the haircut risk is you set aside some reserve because you know you're not going to get that return. You don't want to assume you're going to make 8% and spend it all, then you have a 1% loss. So you set aside a haircut, and lo and behold, it wasn't enough. We talked about that in my life insurance class. Someone that took that last semester. Life insurance companies put aside haircuts for the corporate bonds because they know some are going to default. They don't want to pass all that earnings on to their customers because they need to keep some of it. So the haircut's just not enough. What's daylight risk? We've seen some of that recently. So your CEO, I may tell you a story later about the almost CEO of USA that would have been a disaster. But you have a new CEO and something comes to light, hits the press, front page, hits daylight. You're like, whoops, we might have hired the wrong person. It may not be a good for, but it's interesting. There's a lot in here that kind of strange, kind of jargon for the industry. I don't know if we can see some rollover risk. We'll talk about some in this class. Legal risk we'll talk about. Contagion risk we're going to talk about. So there's some in there, but that was kind of a bizarre universal risk. USAA is just more obvious, where it's just talking those things that typically hit insurance companies and banks. So universal risk, your financial planner will come in with a list like that to help you. Now, risk management itself, our goal in looking at all this, we're trying to optimize the firm. We don't want to just say, don't worry about it until it happens. That's risk ignorance. We're not really even into risk minimization. United Air, they have a problem with, the risk of a plane crashing. How can you minimize that? Well, you just stop flying planes. That would work. But what happens then is you mess up your mission statement. So you have to take some risk. So it's not minimization. Minimization, you just stop doing anything risky. Ignorance, you just say, let's just hope it doesn't happen. That's kind of what happened with the floods, that tragic flood we had here in Central Texas. Is they could have spent a pretty small amount of money for an early warning system, and they said, oh, we just don't want to spend that. We'll just assume it never happens. And then it happened, and now they look pretty foolish. You saw that with ERCOT when we had that last winter storm. That probably won't happen next week. I sure hope not. But they could have done some simple things to have retrofitted those gas plants so that they wouldn't have frozen up. They decided, no, let's don't spend that. It would have been so immaterial to their rate base, but they decided, no, let's don't spend it. That's the risk ignorance side. So, we're trying to do, we're in business, we're taking risks. What we're trying to do is identify those exposures, identify those perils, and then we're trying to come up with an optimal solution. Take the risk when it makes sense, avoid the risk when it doesn't make sense. And so this universal risk is important so that we don't end up having a risk we never thought about. Let's go through. When I was at USA, we got pretty crazy. My boss especially, he was thinking about the contagion side. And he said, well, could hurricanes be correlated to our life insurance side? And he was thinking, well, what if we have this hurricane come over and it's carrying some bubonic plague and it hits us? I don't think germs can survive a hurricane. It seemed kind of bizarre to me. He was trying to get a little too creative. But you do sit there and just think outside the box, what could happen? You can see with Doug Hubbard, a lot of firms, Their universal risk are those things they know how to deal with, so they put them on the risk list, and the things they don't know what to do with, they just hope they never happen and leave them off the risk list. And he says that's not a good approach. Risk analysis is simply just making sure you understand how those two interact, usually pretty straightforward. USA sees a hurricane hit, obviously you're going to be paying a lot of claims. It's pretty obvious. Your defined is pretty straightforward for paper one. I'm going to give you just one risk to look at, which is market risk for banks, which is going to include interest rate risk. You just got to go in and see how they define it and put that in your paper. It's the easiest part of the paper. Some students actually don't do that very well. They completely leave it out. It's like the easiest points on paper one. How does JP Morgan define market risk or interest rate risk? And you'll find it defined. It's really easy. You can copy and paste it into your paper in quotes and then say what your interpretation of that is. It's the easiest part of paper one. They're also going to define other things like a liquidity risk. They might have equity risk, commodity risk, some other things that fall somewhat under price risk. You'll see in the definitions that they have it defined. In fact, this is your paper one. How did they define it? How do they measure it? How do you mitigate it? The hard part of paper one is making sure you understand whether it's a measurement or a mitigation. We'll talk about value at risk. Anybody have heard of value at risk? You should have had that in 3013, but it may have been a while.
What kind of risks?
Value at risk. VAR. Anybody heard of it? USAA uses it. So value at risk, it's a measurement, not a mitigation. Have y'all heard of stress tests? The federal government does stress tests. Does that sound like a measurement or a mitigation?
Measurement.
It's a measurement, right? They're saying what happens if interest rates do this? How much would you lose? Are they solving the problem? No, they're just figuring out what the problem is. Okay. So we'll talk about what are the measurements, what are the mitigation. The number one mitigation you're going to see is diversification. Let's make sure we don't have all our risk in one place. So you'll see that, especially in the value at risk calculation, they're going to show you how much diversification reduces the VAR. That's the mitigation. I'll help you with that. It can get really confusing if something's a measurement or a mitigation. I can't think of too many that might fall in both categories. There's a few it gets a little bit tough, but generally they're fairly clearly either a measurement or a mitigation. And there's some fairly standard ones that I want you to get comfortable with it in paper one. So if you interview with a major bank, you want to know those terms. What are they? And there aren't a large list of them, actually. It's a pretty defined list. So let's get the measurement. Measurement is evaluating two things, frequency and severity. We talked about that in my property and casualty class yesterday. Frequency is a probabilistic thing of what's the chance of it happening or how frequent will it happen. And then severity, when it happens, how large can the loss be? That's frequency and severity. Sometimes it's pretty straightforward. With life insurance, frequency is what's the chance the person dies this year. Severity is real easy because the person just tells us what happens with life insurance. You tell the insurance company what the severity is, right? If you buy a $100,000 policy, what's the severity? $100,000, real straightforward. Health insurance, not quite so straightforward. You got to figure out what's the probability the person gets sick, but do you know how much it's going to cost you? Could be a cold, could be a major surgery, could be $10, could be $100,000. Who knows? So sometimes you don't know. Homeowners insurance could be a few $100, could be the entire house. You do know on homeowners insurance what the cap is, right? Because what are they insured for the replacement value? That's the most this company's going to pay, whatever the limit is. So they do know the max. What's the problem with homeowners insurance? Well, if you have a hurricane hit Miami, it might hit 20,000 of your customers versus a fire might only hit one of your customers. So homeowners has the risk much bigger than auto insurance of a whole lot of stuff getting destroyed all at once in one event. That's the reason the insurance industry doesn't insure flood. Because flood is so devastating and so huge, the federal government says we're taking that over. They might do that with hurricanes. They may do that with earthquakes at some point. If those events get so large, the industry says we can't insure them anymore. But the insurance industry has given up on flood. They don't insure flood anymore. That's the federal government. So that's part of the issue here is on some events, the severity seems almost unlimited. It could almost destroy the entire company. My property casualty class is studying what Berkshire Hathaway went through with 9/11, with the Twin Towers being destroyed, and they insured those buildings, and they had some huge losses coming out of that. It's almost unlimited loss. And that's something insurance companies don't like. We don't like insuring in Italy, because in Italy, like in the US, when you buy insurance in the US, you have to set the max exposure, but in Italy, it's unlimited. You have a liability claim, if it's $1 million, if it's $10 million, if it's $20 million, they have to pay it. Insurance companies don't like unlimited exposure. They like to have a cap on that. So sometimes, like with life insurance, frequency and severity are both pretty simple, pretty straightforward. Life insurance actuaries have a pretty good idea when people die by age, whether they're smokers or non-smokers and all that. They have a pretty good idea on that. It's pretty straightforward. Auto insurance is fairly straightforward. Homeowners has huge risk of major events. Health insurance has obviously become a more political issue than anything else. So that's the measurement side. And then the mitigation side, there's a couple of areas there, risk control and risk financing. Risk control is when you do whatever you can to reduce the risk. And there's two ways you can do it, or three ways. Risk avoidance, you just completely get rid of it. So if your goal is to get married, have 3 kids, have a house, have 2 cars, and you're bungee jumping every Tuesday and Thursday, that's a pretty big peril to that goal, right? That's pretty dangerous. What could you do to reduce that risk? Stop bungee jumping. What happens to your bungee jumping risk if you stop bungee jumping? Are you going to accidentally bungee jump one day? Probably not. So it completely eliminates it. You don't have to worry about it at all. Risk avoidance doesn't work if it's in your mission statement. It's key to what you do. You're stuck with that risk. But there are some famous cases. AIG is a very good example. AIG, an impressive firm, some of the best actuaries in the world, some of the best sophisticated risk managers in the world, toppled by just a department of just a few people doing something that had really nothing to do with AIG's core business. No one was watching it, probably because Greenberg retired. I don't know if y'all know the history of AIG. They had 2 CEOs over 100 years. Pretty amazing. Greenberg, I think, was there for 70 years. A stickler, man, the guy he was a micromanager on risk. He understood it. He was real picky. He got in trouble. They let him go. They had this amazing risk management process. But when Greenberg left, it went from being a process that really controlled risk to just being going through the motions. And AIG started taking these risks. No one was really monitoring it. And this one little department in this great company, there's a few people, destroyed the entire company. That should never happen. They should have not been doing that at all. They should have practiced risk avoidance. Because that department was lucky and made some good money the first few years, they said, oh, they must know what they're doing, let them do it. And didn't look at the downside, what could happen, and they ended up destroying the entire company for no reason. Risk prevention are those things you do focused on frequency. Try and reduce the frequency of something happening. So if you got a pool in your backyard and you're worried about a neighborhood kid drowning, you could fill in the pool with concrete. That might increase the risk of the kid tripping and scraping their knee, but they won't drown if you fill it in. You could, for risk prevention, put a tall fence around the pool. That might make it more difficult for the kid to get back in. So that would reduce frequency. And then risk reduction is you assume the risk has happened. You want to bring the severity down. That might be you learn CPR, or you have cameras, motion detected cameras on your pool or whatever. I do know people who have a pool in their backyard and they just fill it in with concrete. It's like it just sits back there. It's a risk. Why take that risk? Just fill it in. That would be risk avoidance, but these other things might be valuable to help reduce the risk. There are times when you do risk prevention that reduces frequency but increases severity. There's sometimes you reduce severity but you increase frequency. There's just ways these things interact and can be surprising at times. That's risk control. That's everything you're doing. And then risk financing, that's when you bring in a third party to help you out. That's where insurance comes in. So you say, okay, I've done everything I can do to make my house safe. I've got a really strong roof. I'm ready if there's a flood. I got some sandbags I can put around my house, whatever. But ultimately, I need some help. So I'm going to go to State Farm and buy some homeowners insurance. That's risk financing. It's not risk avoidance because if you buy insurance from State Farm and they're insolvent when your house goes down, the risk comes back to you. Risk avoidance is the risk disappears. Risk financing is someone's going to step in when the risk happens. They better be there to help you when that happens. Otherwise, the risk bounces back to you. So risk financing, risk transfer, you're going to have an external party. We won't talk about all of these, but in my property casualty class, we do talk about captive insurance and risk securitization. They're going to do catastrophe bonds, which I love. I don't know if y'all have seen catastrophe bonds, but that's a risk securitization that's really, really, really interesting. Even letters of credit, you might not think of that. What a letter of credit is a bank promises to loan you money when you need it. If you're desperate, you have a liquidity crisis, you have a bank that's going to loan you money, you got to pay them back, but at least you get the cash when you need it. You got them stepping in to help you at that point. So those are the mitigation tools. Once you finish all of that, you can't completely get rid of the risk. You end up with risk retention. You want to make sure those risks you retain, you're getting paid for. You don't want to be taking a risk without compensation. Important phrase, paid for taking risk. I would use that in an interview. It's, if I'm a finance person, it's like, I want to understand risks that we're taking. I want to make sure we're getting paid for the risk. We're not getting paid for the risk. I want to transfer that off to somebody else at a reasonable price. That's what finance does. You're making sure you get paid for risk. First of all, you got to make sure you know you have the risk. So you better measure it. And then once you measure it, you say, are we getting adequately compensated for it? If we're not, why are we taking this risk? Let's transfer it to somebody else. But bottom line, define, measure, mitigate. So there's a risk universe. Your risk universe is pretty straightforward. But be careful. When I started in finance at USAA, the risk management department sat right next to me. There was one guy named Jerry. I don't know if he's still living or not. He retired and went to Costa Rica, but one guy named Jerry. Now risk management USA is over 1,000 people. So they went from one guy named Jerry to 1,000 people. What do you think Jerry did? He only did one thing. What do you think he did? He bought a bunch of what? He bought insurance. That's all he did. Any risk USA had that was mitigated by insurance, that was Jerry's job. He didn't measure the risk. He didn't mitigate the risk. He just says, hey, here's the risk we have. Our building could catch on fire. Let me buy building insurance. Let me buy liability insurance, pollution insurance. We could pollute the environment. We got a plane. We better buy aviation insurance. We got employees that could get hurt. Let's make sure we got workers' comp. That's what he did. Over time, that department expanded out to start doing measurement and mitigation and got bigger. By the time I left that department, they were up to about 5 people. And the last time I went, I met this one guy I'd worked with, and his department was 70 people inside risk management doing stuff my department used to do with half an employee, and he's now got 70. And it's like, my word, you've expanded it. I don't know if they're getting value out of that or not. 1,000 people seems excessive to me, but who knows? That's a lot of people. I talked to one of them just last year. He works in that department, and he has a really interesting job, a lot of measurement. My only question is, is anyone doing anything with all this information? It's kind of like AIG with all the risk management process. It looks really fancy, but if you don't actually change how the organization's operating, you're kind of just filling up a bunch of spiral notebooks, but not much getting protected or improved. So risk management is definitely expanding. When you do paper 1, you may have this concept of a chief risk officer. This has become really, really important. If I could spell chief, That didn't exist 20 years ago. USA has a new chief risk officer. I actually got to meet with the first one they hired. They just hired the first one ever. I just retired. And I had all these strong opinions, say, hey, let's have her talk to Ryan because he can tell her what he really thinks because he's retired. Just tell her where I thought, as she's gonna see at USA, just knowing the dynamics. And she had a big issue coming into this company because the issue with chief risk officers is a lot of firms were hiring chief risk officers for show, just so they say they have one, and then didn't give them any power. Can you imagine showing up at USA as their first chief risk officer and you have no authority whatsoever? You got to build it yourself. That'd be a little intimidating, wouldn't it? You're going to go to the property casualty company and say, hey, stop doing that. What are they going to say? Who are you? We don't report to you. We don't care what. So she had a tough task. I knew it was going to be tough. And I don't know how long she lasted there. She was very strong in her background. She knew what she was doing, but she's walking into a pretty tough environment where people already had their habits, who has the power and all that. It's tough to do that. I tried to help as much as I could, but I knew she was walking into a tough area. A lot of your banks that you're going to do for paper one, you're going to do one bank. I think almost all of them, if not all of them, have a chief risk officer. But the question to ask is, does the chief risk officer really have any power to change anything, or they're there just for show, just to say they have one? All right. Our universal risk for this class, we're going to use this. I got this from the group of 30, which is a group of financial regulators around the country, around the world. My favorite is interest rate risk. We're going to spend quite a bit of time on interest rate risk. It was a big risk at USAA. Two of my biggest projects were related to interest rate risk, and they really worked out well in 2008. So we were glad we did them. That's one of my favorite risks. We won't spend quite as much time with liquidity risk just because liquidity risk is really one of the toughest ones, because it's really hard to measure liquidity risk. We'll talk about it. It does have some important components. And then we'll spend quite a bit of time on market risk. Interest rate risk is a sub-component of market risks. So when you look at your banks, when you do paper one, you're going to notice they don't have a section called interest rate risk, they have a section called market risk, but they'll talk about interest rates under the market risk section. Market risk is pretty straightforward. It's just a risk that an asset price falls or liability value goes up. That's market risk. It's just values of things change. So pretty straightforward. We'll spend some time on credit risk. So interest rate, market risk, and credit risk. We'll spend most of our time on those three: liquidity risk, and the others, not quite as much time. Basis risk, modeling risk, legal risk, disclosure risk, tax risk, operating, purchasing power, currency risk. Operating is the biggest one, just captures everything. And we'll talk about each one of these. I'll be giving you a lot of USA stories on each one of these because they're all very, very different, and you'll have exposure to a lot of these in your career. Now, I saw all 12 of these in my career at USA, and they're all very unique risks. All right, any questions up to there? Let's detour just a second and talk about paper one because you probably want to get started on it. All right, so paper one, I don't have a paper one description out there. Let me just tell you it, and I'll put the description out there. So what you're going to do for paper one, so you're going to pick a major money center bank. And what are your choices? So you'll need to decide here pretty soon. You tell me, what are the major money center banks in the United States? Let's see if we can get them all. What's the obvious? What's the big gorilla? JP Morgan? Who's next? Wells Fargo? They have any risk? They've hit the newspaper quite badly.
Okay.
Or Citigroup? JP Morgan, Chase is part of JP Morgan, right? So, but Citigroup, Bank of America. And I noticed Moynihan's still the CEO. I can't imagine. You would think he would have retired by now, but I wouldn't put Frost in there. And you'll see some people want to do Frost. I'm going to show you the risk management sections of these banks. If you look at JP Morgan, Bank of America's, and then you go look at Frost, it's a completely different world. One is 60 pages, the other one's like 3 pages. So yeah, I wouldn't do Frost. It's more of a regional bank. It's just Frost, PNC Bank, those types are just not big enough to have enough for us to work with. Schwab is not, no, they're really not a bank. Goldman Sachs, we can definitely put the old investment banks in there. And who's their competitor? Morgan Stanley.
Are we considering hedge funds?
Huh?
Are we considering hedge funds?
No, only banks, money center banks. So we're not going to do like BlackRock or any of the big investment firms. There might be one or two more, I can't remember, but I think those are the major ones. We'll see. I'll get you a list. But you're going to take a bank and you're going to bring up their annual report, probably have it in there twice. And all banks have a risk management section. And how do you find that risk management section? Well, I mentioned value at risk. Value at risk is a good way to find it. So if you just do a search on space, VAR space, you'll probably find it if the computer is working. VAR space, VAR space. If you do VAR, it's going to be variety and all kinds of stuff. You see how often VAR comes up? Quite frequently, 49 times. And so here's VAR, and you notice, if I go up a few pages, I'll find the risk management section, several pages.
Might be lower down because I see there's a lot of highlights lower.
Well, but the risk section, we're in the risk section, I'm pretty sure here. Here, this is the credit. I'm not making you write about credit risk. I had in previous classes, credit risk is horrible because it's a massive problem. Credit risk is a huge part of the risk of these banks. And they might go on 40, 50 pages just on credit risk, and it's a mess. It really is a mess. So I'm saving you quite a bit on that. And they break it up: consumer, the real estate portfolio, the commercial portfolio, the derivatives portfolio. So credit risk can be quite tough. But look how many pages this is. And here, senior debt ratings of the corporation. The risk management includes a lot of stuff. A lot of charts and tables. You notice here, lines of defense. What does that mean? That's mitigation, right? They're going to define the risk. They're going to talk about how they measure it. And here's how we define, how we protect ourselves. Managing risk. That's probably the starting of it. Yep. So there it is. I don't know how many pages this is, but it's massive. So what you want to do, pick your bank. Those banks I just listed will all work very, very well. And then find the risk management section. And it will go on many, 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 many pages. You want to read in detail the introductory section and then skim through all the other sections except the market risk. You want to go in detail on the market risk. So you're really focused on the introduction and the market risk. So Bank of America says risk is inherent in all business activities. Sound risk management enables us to serve our customers and deliver for our shareholders, if not managed well. So you can see that philosophy. But you might actually ask, search on Bank of America mission statement. And you might want to ask, how far down do you have to go? They have their mission statement, their scope, their vision, all those kind of things. How far down do you have to go before the word risk shows up? Bank of America's mission statement is reflective of their commitment. Well, let's get the actual mission statement. We asked this question: what would we like the power to do? Core to lives value. You can just go through it looking for the word risk. We have to grow. We have to be client focused. We have to grow. There you go. Didn't have to go down too far. We have to grow within our risk framework. So the word risk comes up pretty quickly. How far down do you have to go with Walmart before you find the word risk? They have a risk section. Does Walmart have anything like this risk management section? Pretty unique to banks. Insurance companies a little bit, but not. I've had some actuaries ask if they could do this project for insurance companies. It's not nearly as extensive as banks, especially these big money center banks. And they're all very similar to each other. It's just a massive section. But you can see here, where to go. They say responsible growth. We continue to learn what matters to our clients. It helps start conversation. So that's our company, responsible growth, business practices, what we offer. So, and there he is. I don't know how old this guy is. Someone look it up. He was there as part of the, well, we'll have to talk about 2008. That's before y'all were born, right? Were y'all born before 2008? Yes. Okay. Do y'all remember 2008? I still have nightmares about 2008, but we'll talk about it. Bank of America was huge in 2008. Let me tell you now, because I mean, it's pretty amazing because that guy's still there. So, so Lehman goes under on that Friday. I'm going home for the weekend, not sleeping for the next 76 hours. So Lehman goes under. That weekend, Merrill Lynch is going under. And if Merrill Lynch goes under, Morgan Stanley's going under the next week. If Morgan Stanley goes under, who goes under? Goldman goes under. How do these investment banks operate? A lot of short-term debt. They're constantly getting funding by the markets. What happens when you're constantly borrowing money every single day and the market loses complete confidence in you? You're done for. So Lehman Brothers is out of business. If they don't rescue Merrill Lynch, Goldman and Morgan can go under. Probably Citibanks can go under. Who knows the dominoes after that? It's going to be just massive. They can't get anybody to buy Merrill. No one wants it. It's too complicated. You don't know what it's. Lehman's a mess. They know Lehman's done for, but it's so complicated. No one knows what it is. Is this a $10 billion problem or a $100 billion problem? And now one says, well, will you buy Merrill? It's like, well, what's their problem? We don't know. It's a $10 billion problem or a $100 billion problem. Would you buy that institution? No way. And then Bank of America comes in and they say they could have bought Merrill really cheap. And Bank of America comes in and they say, you know what? No one respects us. Here we are, this North Carolina bank, got all these big New York City banks. And Merrill Lynch is like this prima donna institution. Wouldn't it be cool if Bank of America bought Merrill Lynch? Just show those guys that were impressive. So they bought them for $30 a share. A stock they probably could have bought for $3 a share the next Monday. Thank goodness Bank of America stepped in and bought Merrill Lynch. You thought 2008 was bad. If it hadn't been for Bank of America, we don't know what it would have been. 2008 was not the worst case scenario. That was the worst case scenario. If they had not bailed out Merrill Lynch, there is no telling what would have happened. So pretty amazing. We had a swap with Morgan Stanley and with JP Morgan. I wasn't worried about JP Morgan, but guess what I was worried about? I was worried about the swap with Morgan Stanley. So I'm very thankful they bailed them out. So this guy, and I don't know, anybody find out how old he is? He's got to be up there because he looked exactly like that in 2008. So they haven't changed his picture. So, but anyway, so important institution. They definitely overpaid, no question. I don't know how well it's done. Merrill Lynch is still around. They still do a lot of stuff, even with that marquee name. But they were highly respected and were going under. So that was a horrible weekend, but it turned out pretty well. So, you know, try to figure out how important risk management is to them. Look at their mission statements. Then what they do is they break out categories. So categories is kind of that risk universe, but kind of in categories. Is the risk universe, there may be 6 things on each one of the categories. So you can see they talk about strategic risk, credit risk. That's the biggest one. That's where it takes up most of the space. You're off the hook. You don't have to worry about that one. But this is the one you're going to do. What was the first part you're going to do on market risk is define it. Does this look like a definition? Market risk is a risk that changes in market conditions adversely impact the value of assets or liabilities or otherwise negatively affect. Or that sounds like a definition to me. Easiest part of the paper. What some students do is they define market risk by quoting the notes from the class. That's not what the project is. I don't want to know what my definition of market risk is. I want to know what Bank of America's definition is, okay? So make sure you give me their definition. They do define liquidity risk. We'll talk about liquidity risk quite a bit. They have compliance risk, operational risk, reputational risk. Then they get into the who. So the first part of the paper is kind of the philosophy, the process, the players. That's what you're really looking for in the introductory section. How does Bank of America approach risk management? And all the banks are very, very similar. Let's get some definitions, how we organize it, and then let's talk about process. The process is going to be the board and then a bunch of committees. And it's going to be messy. I mean, look at this list of committees that they have. There's probably going to be a chart. You probably want to put the chart into it. I don't see the chart yet, but they should have a chart. They don't have one here, but they usually will have a chart where they'll list all their committees. So you can even set up here, executive management, board, you got committees, you have groups. I think they're pretty messy. When I look at their committee structure, it's really hard to tell who does what. There seems like a lot of overlap. So at USAA, we did it very, very differently. We started a group, my department, my boss started a group called the Corporate Asset Liability Management Committee. It was the CALM, C-A-L-M committee, really well labeled. It was our risk management committee. If I could get 10 people to show up, I was really happy. And we got a new CEO, Bob Davis. He heard about that and he says, I'm going to attend that. And suddenly we had 50 people showing up for that committee meeting. He came to every meeting, every quarter. We had that one committee. And that was the way Bob Davis was. Bob Davis was a lot like Greenberg from AIG. Very much, I shouldn't say this, but I'm retired, but very much a micromanager of risk. In fact, one of the most awkward moments, I was sitting in an exec committee and they were talking about Greenberg at AIG and what a micromanager he was. And Davis started speaking. Everyone in the room is thinking, you're exactly the same way. We just talking about, yeah, he's such a micromanager. Blah, blah, blah. Everybody's like, yeah, he is. Yeah, exactly that. But that was Davis's strength and weakness. He made sure he understood everything going on and he controlled it. That's what Greenberg did. And what happens when Greenberg leaves kind of creates this vacuum and you don't have that control anymore. But we had that one committee. Now the individual companies, the life insurance, property casualty, the bank, they had their own committee. But they all reported up through the CALM. So every quarter we took our universal risk, we went through each one and we talked about how do we measure it? How do we mitigate it? We'll talk about some of these in this class. How do we handle credit risk? How do we handle market risk? How do we handle interest rate risk? How do we handle liquidity risk? Every quarter, like on liquidity risk, every quarter, Bob Davis said, what happens if we have a $6 billion hurricane? Where we can get the money from? We sell investments. We securitize the assets. We borrow money from the bank. What if the bank has a problem? Well, the bank can sell the property casualty company some certificates of deposit to get cash that way. We went through every scenario. How much could we get? So securities lending was a huge one, but we had to actually test it. But we thought, well, you can get like $16 billion from securities lending pretty fast. And then Davis would say, are you sure? Have you tested it? Could we actually get 16 billion overnight? And they say, well, we haven't tested 16 billion, but we tested $300 million and the process worked. That's the kind of thing, and that sounds pretty good, doesn't it? He's going through each one. Man, what if this happens? What if this happens? That's exactly what you want a CEO doing. So that was great when he was there. He really activated that committee. What you're going to see with these banks is they have a bunch of committees, and some of the titles look really overlapping. And you can certainly scrutinize that. Is it that clear? I liked our approach of just having one committee that everything else reported up to, and it essentially decided everything. But you might think that's too micromanaging, too kind of centralized. Maybe JP Morgan and Bank of America are too complicated and too major, too big. Here's the governance side, which is really what each group does. So sometimes you'll have the front lines. So you have like a risk committee in a particular line of business that works on that. Then you have the more corporate functions. So read through that. You can't have AI write your paper, but you can certainly take this section and give it to AI and ask it to summarize it for you and see what they have to say. I don't mind you doing that as long as you use your own words when you put it into the paper. What would you think ChatGPT would do if, or Notebook, y'all use Notebook LM? I discovered this last year, pretty cool. What would happen if you put this annual report, Notebook LM, and say, hey, summarize the risk management section? Do you think it would do a good job? Did you ask the question specifically enough? Could you say, read the risk management section and summarize it in a define, measure, mitigate format? Could ChatGPT handle that? Are y'all gonna try it? Be interesting, right? There's stress testing. What is stress testing? Is it define, measure, or mitigate? That's measurement. So they do stress testing. Value at risk. What is value at risk? It's measurement. Well, then what are the mitigations? And I'll give you a good list of mitigations. So you look through those as you read through, watching for those. Then you're looking for specifically the market risk section. So we got to get through all the credit risk stuff, which is just massive. Aren't you glad I'm not making you do the credit risk? This is still credit risk. I got to take the search out. Where's the search? Did y'all know this even existed in banks' annual reports? Pretty important stuff, and it's not written for the average person. The average Joe on the street reading this, they're not going to understand it. Most business majors with undergraduate and master's degrees, this is over their heads too. This is pretty advanced stuff. You can see a lot of jargon. They write this for people who know banks. They're writing this for people who have been studying banks their whole lives. All right, I probably went too far on that, but anyway, you'll find market risk section in here. I'll probably pass it up, but you're looking for definitions and measurement discussions, but you also want to find some good tables. I'll find you some good tables on value risk. They always put a table in there. I was hoping to show that to you, but I'll show it to you here pretty soon. That there's always good. Well, here is a stress test. We'll talk about this stress test. We're actually going to use this stress test on exam 1. USAA did this stress test. What happens to our net worth? What happens to our earnings if interest rates go up 1%? Or 100 basis, you know what 100 basis points is? If you go from 3% to 4%, up 1%. What if interest rates rise 200 basis points? What if it rise 300? What if they fall 100? What if it fall 200? What if they fall 300? There's one year where we said, what if they fall 300? And if they fell 300, they go negative. It's like, what do we do? Can interest rates go negative? And we've discovered since then that they can, but we said, let's not do the minus 300 because that's just not going to happen. Let's just do -2. But that's a stress test, and you'll see this. You could put this table into your paper. Or here's the VAR. They do a 99% and 95. They get it backwards. They get VAR backwards. So they say 99 and 95. At USAA, we don't say 99 and 95. We say 1% and 5%. We do it the other way around. But this is what a VAR does. You have a risk tolerance. They do both a 1% risk and 5% risk, or 99%. And VAR stands for value at risk. And you can see the categories. This is all market risk. They have foreign exchange risk, that's 29 million. Interest rate risk, that's the biggest one, 57 million. Credit risk, the second biggest one. So interest rates and credit risk are the two biggest risks of banks by far. Equity risks, they have a little bit of that. Commodity risk, a little bit. This is all measurement. What do you notice here on portfolio diversification? What kind of number is that? It's a negative number. That is the mitigation. What do they mean by diversification? What they're saying is we protect ourselves by spreading our risk over these things. So when you add them all up, the risk actually is $100 million less, because they're not all going to be at their 1% worst case all at the same time. Well, one's at its 1% worst case, and the other one's going to be doing pretty well. When you combine them all together, you can actually subtract 100. That is a mitigation. So have it in your notes. Value risk is measurement, diversification is the mitigation. All right, all in that one chart. You definitely want to have your firm's value at risk chart in your paper. Really, really critical. The other thing you might want to do, which is really interesting, is to compare between years. So 2022 is really, really interesting because interest rates shot up in 2022. It's really interesting to compare their value at risk 2021 to 2022 because you'll notice it jumps up a bunch. Because they use historical VAR. Talk about historical VAR. Historical VAR essentially uses recent history to figure out the risk. But when things change all of a sudden, that historical VAR is really wrong. And so interest rates shot up. Suddenly, what they thought their exposure was at 100 million, now suddenly it's 200 million or 180 million or something. So it's interesting. It's pretty interesting to compare. You probably can't do this, but compare 2007 to 2008 on their VAR. That you saw a really huge change suddenly. It's like, whoa, we had more risk than we realized. I don't like historical VAR because I think it kind of fools you when times are really stable. It looks like you don't have much risk and then suddenly things pop up. But so there's their risk of their portfolio, 70. They have a few other things that they throw in there. Their overall value at risk is 86. What does that mean? At the 99%, 99% of the time, they expect to lose no more than $86 million at any given day. Which means 1% of the time, they expect to lose more than 86 million. Now, what's interesting is there's about 250 trading days in a year. What's 1% of 250? 2 days, 3 days. So that means 2 or 3 days out of the years, they should lose $86 million or more. But they like to brag sometimes and say, we didn't have any losses more than 86 million. Well, what does that tell you? That tells you that the math is wrong. Especially on the 5%. What's 5% of 250? 15 days maybe or so. If they say they didn't have any, that means the math is wrong. Right? If you think you're going to have 5% of the days you're going to lose more than 45 million, and none of them lose more than 45 million, then obviously you didn't do your math very well. So they're actually telling you 5% of the time they expect to have a day where their portfolio will lose more than $45 million. That's what value at risk does. USAA, we didn't do 99 and 95%. At USAA, it was 1 in 500, so 0.02%, not 0.2%. So 0.2% of the time, USA expected to lose. Now, USA did it on an annual basis. Banks do it on a daily basis. So USA, they're 0.2%. They may say 0.2% of the time, we expect to lose $6 billion or more. Most of that is what? Hurricanes and earthquakes. All right, so that's USA on an annual basis. Banks do it on a daily basis. Insurance companies do it on an annual basis. All right, so you see what you're looking, that's a measurement, but the measure includes one line on mitigation because of diversification, right? So this weekend, start thinking about what bank you want to do, start reading it, get some comfort with the jargon. We'll get better into the jargon as we get into it. So any questions on that? Can't remember if I left a bank out, probably not. You can't do USA because they don't publish anything. It's not big enough, but also it's a private firm, so it doesn't have the requirement to publish this. So you read their annual report, it's fewer pages than even their credit section. It's pretty small. You could do Frost, but if you're interested in Frost, read Frost's section. I think you'll see a huge difference between Frost and JP Morgan.
Did Wells Fargo bailed out Merrill Lynch, or why was it making that?
Nobody wanted them, mainly because they were, you're told in one day to show up. You're the CEO. You barely know your own bank. You're going to really step in and be the savior and buy this bank where you have no earthly idea that it could topple you completely. Merrill Lynch was a pretty large institution. So yeah, no one had the guts. And it really was egoed. Bank of America just said, hey, it'd be really impressive if Bank of America, because they really were well, we used to say the Roger Dangerfield, but y'all don't know who that is, but no respect, didn't get any respect. And they thought they could get recognition for doing that. It's hard to imagine what would have happened that Monday. Oh my word, when it would have been crazy. All right.
Sir,
Uh-huh.
be selecting the most recent annual report.
Well, 2025 hasn't been published, but I'd like for you to do 2025. I'm not sure exactly when it come out. They've been reporting earnings, so it should coming out pretty soon. Start with the 2024. If you do your paper on 2024, it's okay, but keep looking to see. I'll keep watching as well as soon as 2025 comes out. It should be
Should it be, I mean, outside of the numbers that will change, well, you know,
The text should be real similar. You can't imagine they're going to rewrite that. I mean, who writes these annual reports? It's not the finance people, it's the accountants, right? The accountants are real sharp at the banks. They understand this, but this is pretty advanced stuff. You're not going to rewrite the whole thing. You're going to edit it every year. So it's not going to be that overwhelming, huh?
Is there like an example, a couple of years prior, just to make sure?
I won't put an example out there. I'll show you an example so I can show you kind of how I like. So you don't have to do this, but this is a good paper to put on LinkedIn. I recommend you use a professional approach. Some of you have seen this approach before. Actually, I would center this. So you start off with, this is what I'm doing, a summary. In this paper, I'm going to do this. 2-column is far more professional looking. I mean, this looks pretty professional, doesn't it? 2-column. I've seen some that I'll do like a big letter to start it off with. Good use of bolded text. Very important. When you do 2-column, put your margin at narrow. So because you already have a lot of white space in the middle, so have a narrow margin. I like full justification. I think it looks a lot more professional. So we started doing this about 20 years ago. Actually, kind of interesting. A guy who worked for Merrill Lynch, still works for Merrill Lynch today under Bank of America, but he started turning in his papers in this format. And what he did is he went down. I have all my financial analyst journals in the FSC. He took one out and he looked at it and he just copied their format. He wanted his paper to look like a published article. So there's a few things here: 2 columns, narrow margins, full justified, short paragraphs. I wouldn't go more than 10, 15 lines on the paragraph. If you're not sure, break it up. Good use of bolded titles. You can put charts in there that are very clean. Make sure they're well titled. So this looks really pretty professional. He went a little bit overboard on the introductory side, but that's fine. And then when he gets into the paper, what is it? It's measurement. I mean, define, measure, mitigate. So here's the measurement: stress testing, sensitivity analysis, value risk back testing. He has charts that show what's going on. Here's the stress testing we talked about. Looks really familiar. And then he gets into mitigation and talks about those. So it's the organization of the paper is really straightforward. Talk about the firm overall, what did they do, their process, the players, the committees, and then philosophy. Then define market risk. How do they measure market risk? How do they mitigate market risk? And then the last part of the paper, you get to the very end, is your final assessment. And the way I want you to do the final assessment is your assessment of how good of a job they're doing. And is this bank too big to fail and too big to manage? Or is it too complicated? One of the problems Citibank has is it's so global and it's so massive. Some people just think it's just not manageable. There's no way the CEO of Citibank can know everything going on. This bank. Something that can add a lot of depth to your paper is to talk about some of the disasters these entities have had. JP Morgan had the well risk. Goldman Sachs had the Malaysia thing blow up on them. Wells Fargo obviously had the fake accounts blow up them. All of these banks have had something major happen. And you have to kind of ask, how did it happen? The well risk, you think you got Jamie Dimon, surely he knows everything going on. And he's like, I have no idea what was going on. How can you not know? These are complicated, massive organizations, thousands of people all over the world doing stuff. So he talks about that. Is it too big to manage? So that's the last part of it. So y'all get the sense of it. It's those major sections. Now, this is a really good paper. I don't tell me how many pages it needs to be. His is about 10, 11 pages. Part of your grade is critical thinking. Don't ask your first boss, how many pages have to be? You know, I'm really busy. I want to do the minimum amount of work possible. Can you tell me pages? That's not a good thing to tell your boss or your professor. The paper needs to be what? Long enough to accomplish the task. All right, that's critical thinking. So do that. But I like this format. You don't have to use format. I don't count off if you don't, but would you be embarrassed to put this paper on LinkedIn? Looks pretty impressive, right? Especially human resources. How many words is human resources going to read? None. They're just going to look through and say, hey, look how good it looks, because they're not finance people, right? If it was a paper on human resources, they read it, but it's finance, I don't care, but it looks really pretty, looks really professional. And then the one question you might get is, did you write this or was this a group project? And if you say I wrote this entirely by myself, it gives you a huge advantage of your competitors. You're going to notice the section he has are real similar. Banks do, here's his market risk definition. Banks, these major money center banks, very, very similar risk management processes, terms. You are going to hit some jargon that's going to be a little tough. You can try Googling those terms and seeing some of the terms are very industry jargon terms that we all use. Some of the terms you're going to find are specific to Bank of America. It's a term they came up with and only they use. So you'll find that some. So start working on this weekend. Definitely decide on your bank and start reading the risk section.